Are we live? We are. What's going on, my fellow wealth creators? Matty Ice here. Got an awesome conversation for you today. Really been looking forward to this. I got Mr. James Barber here from Oregon Cashflow Pro. Make sure you check out his YouTube channel. Awesome stuff. But I wanted to get James on and have a conversation, continue the conversation about IUL, whole life insurance, how it fits into the financial plan, all this stuff. Because he actually, James, you had a really good conversation with Chris Kirkpatrick the other day on Caleb's channel, which I recommend you guys check out as well. But I just wanted to continue the conversation and bring up some things that, you know, when I was listening to, I was like, yeah, you know, I'd really like to get his perspective on this, and this. And I think the more conversations we have about this, because there's certainly not enough of them, I think we would both agree on that. There needs to be more conversations like this where people can hear both sides of the story. All right, because at the end of the day, it's not necessarily whether whole life is better than IUL or vice versa. It comes down to what's best for you. Because, like, even though I'm not a huge fan of IUL, it doesn't really make sense for me. That doesn't mean it doesn't make sense for other people. But the problem is so many people are not, like, they don't know what they're actually putting their money into. And I think we would agree on this too, James. A lot of these agents don't know what the hell they're doing. And so that's, first off, I want to say thank you for taking the time to get on my channel and have this conversation, because as we were talking before we went live, I've invited a lot of people onto my channel to have this discussion, and I just get crickets. You know, they're really good on the keyboard, but when I say, hey, let's have a conversation about it, I get crickets. So I want to thank you first and foremost for getting onto the channel. It really means a lot. And I think it's going to be very productive for people to hear both sides of this. So first off, thank you for being here, man. I really appreciate it.
Happy to be here. I think maybe you're getting crickets because wrong answers and things like this could be detrimental to somebody's business model.
Oh yeah,
100%. If they come on and they get exposed, like
Right.
I did a video response a couple of weeks ago, maybe it was a few weeks ago now, for somebody that had put out some like really severe misinformation, and it had been going on for years. And I finally made a video calling it out.
Mm-hmm.
And this person contacted me and was devastated. They were like, you ruined my business. For the first time, I don't have any appointments scheduled.
Wow.
And I'm like,
okay, don't get on your bad side.
If your business relies on me not calling out misinformation,
Yep.
I don't know what to tell you.
You're probably in the wrong business, dude. You're probably selling the wrong stuff. If it can be so easily dismantled, I don't know. Maybe time to rethink things a little bit.
Yeah.
You know, because your entire business shouldn't collapse because somebody challenges you on what you're selling, what you're saying, what you're sharing, whatever. Like, your entire business should not collapse because of that, right?
Yeah, and if you're going to put yourself out there, do your research.
Yeah.
Put out factual information. That's all I ask. I don't put out response videos where I just have a slightly different opinion. Like, there's no value in that for clients. But what I don't like is to see misinformation out there. If there's something that's wrong, like, people go to YouTube University, because they want to learn. And I just view myself as an educator, and that's what we're trying to do. We're just trying to educate people on all these products. I'm pretty agnostic when it comes to what people want to invest in.
Right.
We just try to figure out where things fit. Now, obviously, I make my business selling life insurance products.
Sure.
But, I'm not a salesperson. I just educate. The sales will happen. If we can identify the right product for the right problem, get the right solution, it's going to happen. And that's
really what it's all about, man. I was telling you earlier that I had one other. I don't think he's licensed, but I don't think he's like technically an agent. Like, he doesn't work with individuals one-on-one. He's really knowledgeable about index universal life insurance and all kinds of different products. And he's the same way. He's product agnostic. You know, he does whole life, IUL. He does it all. It just comes down to what the client, what the client's needs are, what you're trying to accomplish. And but like the way he actually structured it, you know, because he came onto the channel. We did a full, illustration and all that stuff. It's like, man, that actually, you know, if I were to buy an IUL, which I'm not, okay, just not, it's not for me, okay.
Sure. Sure.
If I were, this actually looks like how it probably should be illustrated. So let's like really get into the meat and potatoes of the conversation that we want to have here. Because I think also too, what I was going to mention is like this type of conversation. I think is really good for potential for consumers as well, because so much of the content out there is just one side of the story. Like
Yep.
just real quick on my background getting into this, I got into this business as a consumer because I have a marketing agency as well. And as it started doing good, I was starting to save up some money and I wanted to deploy it. Well, I'd heard about infinite banking, I'd heard about IUL, and all I was hearing about was just how amazing it was. And you can get all this upside potential, downside protection, ridiculous amounts of tax-free retirement income. You can never lose money in it, right? It sounded really good, but then thank God I heard the other side of the story, because once I learned all the different things that could change and could go wrong, it just doesn't fit my risk profile, man. And I thank God I didn't do it, because I almost put a lot of money into it. But I like
Well,
conversations like this
let's be
because,
clear. Let's be clear, because I don't think you mentioned it there at the beginning. Somebody was trying to sell you the IUL,
right,
and
correct.
that was what was misrepresented to you.
Correct. Yeah, 100%. And it's like I only heard that one side of the story. I almost put a lot of money into that thing. Thank God I didn't, because it wouldn't have been right for me. And even though I'm not a fan of IUL, it doesn't make sense for me. I say this on my channel all the time. It's like, dude, if you actually understand how it works, you need to manage it. It's got to be designed right. You absolutely have to be working with the right person, 100%. If you want to do it. But 99% of people have no idea what they're putting their money into. And you see all these lawsuits popping up all over the place, people getting in trouble. And you see like a lot of these agents don't know what the hell they're talking about. It's like, you got to do your own research. You got to hear both sides of the story so you know what you're putting your money into. That's what I have the biggest problem with when it comes to IUL, is this misrepresentation of it. All right, so you were saying that you did a review video the other day. Let's talk about some things that you called out, because I did one the other day as well. And let me point out a couple of the things that I called out. Give me your take on this. All right, because I just think this is a huge misrepresentation of what an IUL is meant to do, I guess. He was talking about it always ranges too. It's like it's either 6 to 8% or 7 to 10% compound growth for the life of the policy. And I'm just sitting here thinking to myself, like, can someone please show me an IUL that is averaging 10% every single year that's been enforced for at least a decent amount of time? Because you might have some good years, but these are long-term products that we're putting money into. All right, is there really an IUL out there that's compounding at 10%? Because when I hear that, that sounds really good. And then immediately after that, he said, you can't lose money in this thing. And that's right there, man. That is what really gets my skin crawling. All right, so give me your take on those points, because those are some of the points out there that are just like, I hear so many agents talking about the compound growth, and you can never lose money in it. What's your take on it?
Sure. So technically, you can't lose money. What do you think about what is losing money? Losing money is you have money that goes into something that's going to go up. You expect to go up, and it goes down instead. You don't consider it losing money if you go and buy a product. So like if you go to the store and you buy an apple, you didn't just lose money because you bought the apple. You
Sure.
got the benefits of the apple. You got to eat the apple. So in an IUL, you don't lose money because the value in your account doesn't go down when the market goes down, right? Zero is your hero, as they like to say. But your account can go down because there's expenses in the policy. You're paying for a product. So when people say that you can't lose money, yeah, it's technically true. It doesn't mean that your account can't go down, though. And that's where design is important. We got to make sure that we design for minimum expenses so that when we do get those 0 years, your account doesn't go backwards very much, right?
Right.
Now let's shift over to the 10%, 12%. There probably is some policies that are averaging that. These are probably going to be a carrier that offers some type of uncapped S&P index option that somebody happened to like hit the lottery because they funded it at the bottom of the COVID crash. And the very next few months, it shot way up. And by the next year, it was up 99%. right?
Right.
And that, when you average that out with all the other time period of that particular product, which probably was not in effect for all that long,
Right.
it probably is averaging 10 or 12% at this point in time. Is it going to do that for 30, 40, 50 years? I doubt it.
No.
Highly, highly doubt it.
You
I
can't
like to set
sell
the
policies based
expectations.
on that number, on that
Yeah, no
anomaly.
way.
You just can't do it.
Absolutely. Not if you're serious. Not if your goal is setting realistic expectations so that your clients are happy. But a lot of these people, that's not their goal. Their goal is to sell.
Right. To sell.
They want to make money.
Right.
And it's
Right.
easier to
100%.
do that if you can point to this one time that somebody got this massive return.
Mhm.
I can guess who you're talking about, and a lot of these same folks, they'll talk about how over the life of the policy you have expenses that are like 1%.
Mhm.
These are not well designed policies, and they're very, very expensive in the early years. They maybe get down really close to or a little bit under 1% 30 years down the road.
Mhm.
And so when they're talking to somebody about it being averaging 1%, they're not going to be anywhere close to that for a long, 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 long time. And
Right.
when these things are properly designed, in 30 or 40 years, your expenses should be down around like 0.1%.
Right.
When you're done funding
Should
it
be
and you've
negligible.
reduced, yeah, it should be a really tiny amount. So that if we start out with nice low expenses at the beginning, that first year might be 10%, but then it's going to drop to 5 and then 2.5, and then it's just going to keep going down. And eventually it gets to 0.1. So like your average over that time period should probably actually be around 0.5%, maybe
Right.
even less than that, which is a massive difference from the way that these people try and sell it. But then they talk about you're getting 10, 12% average minus your 1% expense, you're going to be at a 10% compounding. And it's just such an unrealistic expectation. It's frustrating for me to see that too.
And they can make that happen on paper. Like it looks really good on paper, but what actually happens in reality, that's a whole other topic. Now, couple things I just wanted to just fill in. A couple things that you mentioned. You made some really good points about the expectations and policy design and stuff like that. Actually, first off, let me ask you this: with regards to averages, all right? You got people saying 7 to 10% with these things. In your experience, like what do you expect an IUL to do over the long run? It's designed right, whatever. You put it together. What do you expect it to do? Like I hear David McKnight says they should do around 5 to 7%, right around there.
Yeah,
agree with that?
I would agree with that. I like to illustrate around 6%. I actually illustrate basically everything at 6%. I think it's realistic, and I actually think that we can beat it. One of my personal policies I've had for 5 years, I'm averaging 7.3. And this is a policy that the only index option that I've used in it is an S&P with a cap. The cap started out at 11. It went all the way down to like 8.5, and now it's back up to 9.25.
Okay.
And I'm averaging 7.3. I'm really happy with that. I'm beating the expectations.
How long has it been in force?
5 years. Actually, we're
5 years. Okay.
Actually, no, over 6 years now. So I started in November 2018.
Okay.
And I put all of my policies, I have a bunch of policies. I put them all up on my YouTube channel. I do a review every single year so we can see how it's going. We can track the results.
Right.
So,
gotcha. Okay. No, that's good.
Transparency. How I designed it.
So
you can transparency is everything.
Yeah, absolutely. And here's the thing too. Like I've had conversations with other people about like the performance of IULs, and it's not that IULs can't perform and that they won't do okay over a certain amount of time. It's just all the things that can change, and again, it just comes down to risk profile. Like I think you mentioned it. You said something on your podcast with Chris Kirkpatrick that really resonated with me, and you made a very clear distinction that I appreciated, and that's that whole life is more of like the savings alternative, because I hear agents talk about IULs being savings alternatives all the time. Like it has nothing to do with, like it doesn't even closely resemble a savings account, in my opinion. And IUL is more like the investment alternative just by the nature of how it operates. Like IUL, you're typically using some type of stock market index to for the performance of the policy. That's not the case with a whole life. So that I think that distinction was really important as well, because understanding like how do these things fit into our financial plans, I think is really important. I wanted to make that as a side note. We'll bring that up in a second. But a couple of points I wanted to bring up that I don't want to lose here. You mentioned, let's go back really quick to like the idea that you can't lose money in an IUL, okay? Which is kind of like a half truth, because like you said, you can't technically lose money in the market, right? Obviously, because you're not directly invested in the market, but you have costs and expenses. Now, if it was explained like that, which most agents do not do, they just stop at you can't lose money. Every agent I've heard say that never immediately follows up with, but your cash value can go backwards because of cost, fees, and all this other stuff. And the problem is, when I hear that I can't lose money, and then I look at my statement and my account value has gone backwards, in my mind, I'm thinking like, well, now wait a minute, you told me I couldn't lose money. Oh, well, that's just costs and expenses. Well, it would have been nice to know that, because you told me I couldn't go backwards here, and now people are like just pissed off at that point. It probably has a lot to do with policy design as well, but the way that it's presented, like, guys, you can lose money in an IUL, not technically in the market, but your cash value can absolutely go backwards. And here's the other thing I wanted to bring up about the cost, James. I would love to hear how you present this to clients, is the idea of these costs and expenses. All right, because I think another misleading thing that's out there that I've heard many times is that your cost of insurance gets cheaper as you get older. And I think what they're trying to say is that your overall costs in the policy are going to go down. But there's a lot of nuance to that, because in an IUL, because it's built on annual renewable term, your cost of insurance actually increases every year. Now, does that mean you're going to pay more every single year? Not necessarily, but that's where the management of net amount at risk comes in.
Correct.
You have to manage the net amount at risk. Well, if you don't know that, if the policy does not perform, even if it's designed correctly, if it doesn't perform, if you or your agent are not managing that net amount at risk, and let's say the policy didn't perform quite as illustrated, and your net amount at risk is a lot higher than what you were anticipating, well, yeah, that cost of insurance can start to become a problem. Now, is that a deal breaker? No. But you have to know, you got to know that you need to manage that.
So,
right?
let's talk about that for just a second.
Go ahead.
When you say that you got to manage that net amount at risk, you're saying it in the sense that I get the impression you listened to Chris Kirkpatrick in his great debate 10 months ago, where he was talking to another agent, and basically, and he's probably repeated this since then, that you need to be making sure that net amount at risk is as low as possible each year. And that's something you actively have to do. You don't have to actively manage that. The insurance company will do it automatically. Like, you just change your death benefit option to level. You go to option A, and you have them reduce the death benefit to the guideline minimum. The guideline minimum is the minimum net amount at risk, and it will automatically adjust every year. So it's not something you have to actively do. When you're done funding a policy, if your goal is maximum cash value, because that might not be the goal, but if your goal is to optimize, to minimize expenses and maximize the cash growth, you're going to switch from, if you were an increasing death benefit, which most of the policies are, you're going to switch from increasing to level, and you're going to have them switch it to guideline minimum for the amount of death benefit that you want to pay that's above and beyond that cash value. So there's not this complicated management. That's the thing.
Yeah,
so it's a one-time thing.
Right, and you're right, and I appreciate you clarifying that. It's not something that like you're managing on necessarily a regular basis, although you do want to be looking at enforced illustrations every year, all right, because there's a lot of things that can change, which we'll get into here in a minute. But it's not like you're actively managing net amount at risk all the time, but it is very important to, if you're doing that increasing, change it to the level. When you were talking about like adjusting to the guideline premium, I've heard of this concept before. Clarify this for me. Where let's say like the policy didn't perform as illustrated, you have more net amount at risk than originally planned for, people will lower the death benefit to shrink the net amount at risk at that point?
So there's kind of a misunderstanding about the product in general, or what type of product we're talking about. A lot of agents will sell a level death benefit product. If you sell, and this happens all the time, I'll get people that have $1 million death benefit. It's a level death benefit. And the reason they got that, the agent told them that was a good number. A lot of people like to have $1 million death benefit, so that's what they buy.
Right. Looks good.
In a level death benefit, as you fund it, the cash goes up and your net amount at risk drops, because the net amount at risk is the difference between the cash value and the death benefit. So that drops. So if it doesn't perform as expected, you will have more net amount at risk than you anticipated. With the way that we design our policies, pretty much everybody I work with, we're going for cash growth. That's the main purpose of these things. We're going to use an increasing death benefit. If our increasing death benefit, if we start it at $1 million, because they're going to fund it a lot. $1 million is, you could put a lot of money into $1 million policy. Okay. Like I have one that's a 1.1 million. I can put 80,000 a year into that thing. Okay. So not everybody needs $1 million, but if it's $1 million, that's our net amount at risk. It stays $1 million as long as I leave it at an increasing death benefit. So it doesn't matter what the performance is. It's not going to change the net amount at risk.
That stays the same.
Net amount at risk will be whatever it is that I set it at, because that's the MEC space that I wanted. MEC is modified endowment contract. The death benefit determines that MEC space. At some point in the future, whether I underfund it or whether I decide I'm done funding it or I want to reduce what I'm funding it at, I'm going to make that change from an increasing to a level death benefit. And if I don't need a certain death benefit, I'm going to switch it to that guideline minimum, and that determines that minimum net amount at risk. So there's no point in there where I'm guessing what's my net amount at risk. Is it higher than it needs to be? Should I lower it? If somebody has not max funded a policy, they can reduce their death benefit. It will adjust the MEC space. It could lead to some other consequences inside there that may limit funding for a bit of time because of how MEC limits work. MEC limits are pretty complicated. For the most part, if we design the policy correctly for the funding level they're doing and they're max funding it, you're not going to have any issues with this stuff. But it can get complicated if we need to change some stuff in there. And there can be adjustments that are made that doesn't just drop it to the minimum. And what I always tell people is, when we get to the point where, in the illustration we did, our plan is to stop funding it, drop it to the guideline minimum, and reduce those expenses. We're not just going to automatically do that. It doesn't happen automatically. We're illustrating it, but it's a step that you have to actively take.
Right.
When it gets to that point, we're going to have a conversation, because you're not going to want to give up $1 million in death benefit to save a few $1,000s if your health took a turn for the worse and you might die in a few years. That doesn't make any sense, right? So we have a plan going into it. Things can adjust. We got to talk about it.
Right.
Annual reviews are important. Annual reviews are important, not just for things like that, but as you said, there are things that can change. We want to review the index options we're using. There's so many different index options that are available these days, and your agent should be on top of it. They should understand what they're doing, what type of index options are better for the type of environment that we're in, things like that.
Yeah, that's actually a good transition into that. I really want to hammer on that. But also just real quick, I think like we're starting to show just how important it is when it comes to who you work with, like, because these things are not as simple as they're made out to be. They're pretty complicated. All right. I mean, you gotta stay on top of things. And that kind of leads me into what I wanted to talk about next, was these indexes and policy design and the changes that can happen. Again, all these things are not necessarily deal breakers, but you need to be aware of them. All right. So let me ask you this, James, because one of the arguments that I hear oftentimes about, like when I do content about IULs and stuff, it always comes down to policy design. That the policy wasn't designed correctly. Okay. Now, is policy design important? Absolutely. Of course it is. Why wouldn't it be? right? But here's the issue that I see sometimes. I'd love to get your thoughts on this. What happens when you have this perfectly designed IUL, but then the life insurance company starts changing everything? You're talking about earlier, like cap rates have changed and there's new indexes that you have to, stay on top of, but it's really like, the issue of this cap rate integrity, where these companies will sell the IUL when the cap rate's at 10, 12, 13%. But then, I don't know, 3, 5, 10 years into the policy, it's dropped pretty significantly, even though they're selling new products at the original higher cap rate. Like, to me, that's just, I don't know, that seems like pretty shady business. But what
That
does
doesn't
that
really
do?
that doesn't really happen.
Well, I mean, we've seen it quite a bit. Like,
You're not
you're
you're
talking
not
about
going to find it.
companies dropping cap rates?
You're not going to find a cap rate that is extremely different now than it was when it was sold, and a newer product that has that higher original cap rate. Like, that generally isn't happening. There can be small differences, but there can also be drastic differences in the products. So there's a few things that we need to understand. First of all, insurance companies are not, they want you to succeed. They want you to grow cash value in your policy, because that's going to ensure that you keep sending them more money. And like, that's the lifeblood of their general fund account. When they get new money every single year, they get to buy the new bonds or whatever the new bond rates are, and they know exactly what they're going to make for the next 10, 20, 30 years. So they don't just make changes on a whim as if they don't care about you and they don't care about the performance of your product.
Well, no, they do it because they have to manage their own risk. They need to be profitable too.
Absolutely. Anytime you buy a life insurance product, whether it's an annuity, whether it's whole life, whether it's IUL, you're buying into a cohort at that time that is in a certain interest rate environment. And the product that you bought was designed for that environment. We are in an entirely different environment today than we were 5 years ago or 7 years ago. Massively different interest rate environment.
Yeah.
Back at that time, let's go back even, like 7 years ago. Even 7 years ago, the interest rate environment hadn't gotten to the lowest point that it reached before it rebounded and came back up to where we're at today. So cap rates were fairly high. This also happened to be a fairly new time for IULs. And so you've got a lot of companies that, let's just say, they were ambitious as to what options would cost, what they might expect to happen in the future. Certainly options were cheaper during that time period. We have a lot more volatility going on now. And there's a lot of things that factor into options costs. So it's not the insurance companies want you to do bad or want your product to do bad. That's not the underlying thing, what's happening in here when we see changes happen in the product. And I think it's important to understand that changes can absolutely happen inside these products, but we want to know why. Does it make sense? I mostly want to stick with carriers that have shown cap rate integrity, that have shown that these things don't just change willy-nilly. They don't change year to year, just like something that I can't identify, some reason that I can't identify. There are some carriers out there that have like 5 different IUL products, and they'll put out new ones every single year.
Yep.
And just because they put out a new product doesn't mean they're doing something shady. It doesn't mean that they're just trying to offer something different. That new product now exists in perhaps a different interest rate environment, and they might have structurally changed that product so that the expenses apply differently, and you might get different cap rates and participation rates within that product. I'm not saying that's the case all the time. That is absolutely not the case all the time. There are probably companies out there that are shady, just like in any other business. Yeah. Okay. So there are valid complaints out there about some of the things that companies might do. And I know Chris talks about how the people that he worked with in one of these companies were like not the most, they didn't have the most integrity. Okay. And so that definitely fed the the impression that he has and the feeling that he has towards IULs.
Well, it seems
Those
to,
things do matter.
yeah, well, absolutely. And whether there's malintent or not, it still has a significant negative impact on the long-term performance of the policy. If I start at a 12% cap rate and now I have 9 or 10, like
Sure.
percentage-wise, it may not be
We
much,
got to
but
look at
that makes a huge difference.
but we got to look at the reason why that happened. And
But
like,
regardless of
what's
the reason, though, it's still negatively impacting the. Well, like,
doesn't
what do
matter.
you do at that point?
I get it.
Well,
But
it
what else
does.
is going on? What else is going on in the world? Was there a better alternative? So like most people that are criticizing the IUL, the answer is whole life. But the same thing happened in whole life during that time period where the interest rates are coming down because general fund accounts of insurance companies were severely impacted and the
Sure.
rates kept coming down. And so we see the dividend rates. You had people illustrating 8, 9, 10% dividend rates a while back. None of that came to pass. Everything came down. Dividend rates all came down basically
Sure.
to about 6% or lower. And so everything has
But
been
it doesn't.
underperformed.
The difference, though, is it doesn't put the policy at risk. Like, it doesn't significantly increase the risk in the policy. Yeah, expectations are not going to be met, and that I would be pissed off as well. But if my IUL is underperforming, again, we could pull levers and we could manage it. Maybe we could 1035 out of it or whatever. But
Well,
it
if it's
injects
designed
more risk
properly, it's
into the
not.
IUL.
If it was designed and funded properly, though, it's probably not a risk just because the cap rates came down. I mean, look at my policy. I designed it properly. I max funded it. Cap rate was 11.75 when I started, came down to 8.5. Now it's at 9.25. I'm outperforming my expectations. I'm outperforming my original illustration. I illustrated at 6%. I'm averaging 7.3.
Right.
Like, that's a big difference. And it happened during that time period where everything was coming down. So what's the expectations that we're setting?
Yeah.
I mean, obviously, I would have been really disappointed if I had that illustration assuming 8 or 9%. And then obviously everything came down. I mean, massive difference in reality.
If you're doing if you're showing 6%, which even still, I tend to have an issue with like showing the growth every single year because the market doesn't go up every single year. Yeah, could it average that? Maybe. I guess it depends on how much the company changes, though, and I guess that's one of my issues. Well, not. It's one of the reasons that IUL doesn't make sense for me is because there's so many things I can't control inside of it, and like I want to share this with you really quick, Dave. Finishing up on the
while you pull that up, I'd say
cap rate integrity.
Yeah, while you pull that up, I would definitely say that your risk tolerance and what you want to deal with makes a big difference. So like this is you have a business, you have a separate business that likely occupies a lot of your attention. You don't want to spend your time dealing with the possible changes that are going on.
Right.
Used to analyzing this stuff. I got a guy that he ran, I don't know, 10 million simulations before he bought because he was comparing it to what happened and then what's the worst case scenario and which bonus option should he use. Like I get people that are super detailed and they're willing to get into this stuff. That is not for everybody for sure.
Yeah, definitely not. Risk profile is huge. Sorry, guys. I was like, you saw a bunch of crazy stuff happening with the cameras there. I was trying to share my screen. It's not coming up for whatever reason.
I did see it come up for a second. But
yeah, I for some reason my studio's been acted up when I try to do a screen share and I have a guest. So I'll just basically what I was going to show. I've shown this on my channel before, but it was like just a renewal rate history report of some of the top like IUL carriers, like and the difference in the cap rate now, what current policyholders have now who purchased 10 years ago versus what new policyholders are getting now. It's just, I don't know. It's just like I said, I'm sure there's not any malintent, but it still has a pretty significant impact on the policy. Like the most egregious one, I don't know if you work with this carrier or not, or if this is a good one. Lincoln, their Life Elements product, inception year 2007. It was originally illustrated at 11%, and then now it's 5.25%. But they're selling it again, like their new issue, that is, at 11.5%. So new policyholders are getting this higher cap rate, while current policyholders who have been loyal for 10 years
Yep.
are at 5.75. Now that's an extreme example. Obviously,
Sure.
not all cap rates are going to go down that far.
Let me give you an idea of why that might happen in a legitimate scenario that there's no hanky-panky going on. It's just the reality of what happens. Okay. So Lincoln had a certain general fund performance that gave them a certain options budget when they first sold that policy, and that gave them that cap rate. General funds came down throughout this whole time period. Okay.
Yep.
So as their general fund comes down and people are continually putting in new money, they have to buy new bonds at the rates that are available at that time. So as the new rates come in and they're going down and they continually have to buy it, their general fund account performance comes down and comes down and comes down. They have no control over the reduction in the options budget that's happening for that product.
Right.
Okay. Now, that's what's happening in that product. Fast forward to whenever they switched product, whatever this new product is that they're offering, it's not the exact same product that people were buying back then. It has some different
because it's we're in a different environment.
Yeah, but it has some different number after it, and it's entirely possible that they closed that book of business and they opened a new book of business. When I say they closed and opened a new book of business, this means like they created a new general fund account for all the money that's coming in now for these new IUL products. The money that's coming in is coming in a different interest rate environment, and they're able to now buy these bonds that are at a much higher rate, and they're not being dragged down by the previous 10 years that brought all those rates down. So let's say they've got $5 billion that's in all of those old accounts that were started back in 2007 that went to the end of whenever they offered that particular product. And all the bonds that they bought gives them an options budget that's this big.
Right.
And because they closed that, those people are still putting money into their policy, and they're going to slowly start to recover because they are going to add those new bonds. But it's not the same as if they didn't close that and they're getting all the new money that's coming in. And all the new money that's coming in is buying bonds at this rate. And so their options budget is this big for the new product. That's why it's back up to 11%.
Right.
Is it fair? Maybe not, but here's the alternative. If they didn't close that book of business and it really did as bad as it seems like it did, where it brought all those rates down, they're going to turn that thing around so slowly, they're not going to be competitive with any of the other insurance companies out there that did the same thing that they did or managed their book of business better.
Right.
Have a better general fund account performance. Either of those two things can happen, and that puts pressure on Lincoln because they're not bringing in the new money. Mm-hmm. So whether they're not bringing in the new money because their product isn't competitive, or they close the book of business and that book of business is not getting new money, it's the same situation for the people that owned that. They don't have the money to increase that budget. In the second situation where they didn't close the book of business and they just lost new business because they're not competitive, now you're talking about an insurance company that could be in a downward spiral. And that's going to be more detrimental to those policy owners. So like, there's a reason to think about this stuff as to why it's happening. You certainly don't want to be in that position. It's critical that you choose a good company that manages this stuff well, has a really strong performing general fund account. I mean, sometimes there's no way around it. If you find yourself in that position, your best bet is to 1035 exchange. Get into something.
Yeah, it depends.
Yeah, and if your product was designed properly, your surrender charges are going to be minimal. Your expenses should have been minimal, and you should be able to get out of it with minimal expenses.
Right, but if you have a really long surrender period, you're kind of screwed. I mean, depending on where you're at with it.
It depends.
You can end up taking a pretty big hit.
It depends. So, like, I'm still in my surrender period with the policy that I was talking about. My surrender charge is like $200. I mean, it's almost nothing. If I want to get out of this thing, I can get out of it.
Sure. So all of that, all that makes sense. And you know what? It's absolutely a fair. This is where risk profile, I think, really starts to come in, and just, I guess, preference, goals, priorities, things like that. Because it's absolutely a fair argument to say, well, the same thing happened with whole life policy owners, right? Like there were whole life policy owners that set up their policies when dividends were 8, 9, 10%, and now they're coming down. The company I'm with right now, Lafayette, one of them anyways, it's 5.75. I started at 5.2%. It's now at 5.75%. But I guess the other thing though is that the whole life companies, or like these whole life policies, they're not selling 8% dividends again to new policyholders like these IUL companies are. I don't know. It's just something about that just really irks me, man. Like,
Well,
I'm sitting here with 9% and you're selling stuff at 12 and a half. This is aggravating.
They can't do that in the whole life though, because they're still giving the dividend. All
Right.
the policy owners,
Right.
all of the policy holders are owners of that company.
Correct.
So they can't close off that book of business. Although they kind of can. And it does happen with some carriers. How that ends up happening is when they switch from a mutual company to a mutual holding company, they close off a book of business. So there can be a situation where a book of business does get closed off in that, but not if it's still your normal mutual company that has no issues.
Right.
So you're not going to see that happen. But this is the difference though. That part of the big difference there is it's the options budget that changed. It's the options budget that gets that cap rate up to that same position that it was a while back. Right. It's not the overall profitability of the company.
Right.
And
I think that's a really important point for people to understand though, because this kind of like so many agents don't go into detail with clients like this, like where everything you're talking about makes total sense. And when I started to learn about the options budget, cost of call options and all that, I was like, oh, okay, you know what? I don't really, this isn't what I thought it was. Right. And so granted, again, just to finish my comment about the risk profile, like, yeah, dividend rates have come down and policyholders earlier, kind of screwed on that. But I would rather have a declining, like, type of fixed rate type of, it's not really a fixed rate, but if we're like comparing other financial assets here, I would rather have that come down than, in addition to my cap rates and participation rates come down, I still have to worry about the options budget and the cost of call options and all these other things that I don't really have any control over. And so again, this is not a deal breaker necessarily. Right? Like you mentioned earlier, and I brought up like it being an investment alternative. If you're okay with this stuff, that's fine. But for me, when I started learning about all the different components, all the different things that are involved with this product, I was like, I don't know, man. I've got to worry about stock market. I've got to worry about options. I'm just no, I'm good. Not for a savings alternative.
Yeah, let's wrap this up because I'm short on time here, and I would love to come back on because I'm sure you have a bunch of other questions we didn't get to. So just let me know. We'll be back. But
for sure,
it's not necessarily that complicated. If you have a good agent and you get a good product, the product can't change all that much. There are some things that can change. There are some products that the insurance company has a dozen levers that they can pull that will adjust things inside of it. And there's some products that there's only a few things that can adjust. Those are the ones I like. I like the ones that there's just a few things because I expect that product to be the same 30 years from now as it is today, except for cap rate, participation rate, whatever those things are. But they don't reserve the ability to change so many different things in the policy that it looks nothing like what I originally purchased. You do need to watch out for that. But it can work for people that just like to set it and forget it. And it's just an alternative place for them to sit and grow their money in a different capacity than a savings account or a whole life policy or money that they're investing in the stock market or have in a retirement account. So it's not necessarily something to be feared. Like if you go think about your car, okay? If you want to go and look at the engine and all the intricate parts that it took to put that engine together that makes your car run, you can fret about that all day long and all the maintenance that might happen in the future that needs to happen. Like you don't have to know about all that stuff to be able to drive a car effectively. to have it do what you need to do to get you from point A to point B. You don't have to know all that stuff, and you don't necessarily have to manage that stuff. You do need to have access to an oil change place or a mechanic that can help you with this stuff when it's needed, right? But essentially, it's going to do what you want it to do. You don't have to dig into it, but you certainly can. And IUL, I think, is kind of the same thing. Like, you can get into the weeds on this stuff. I don't think you necessarily have to. You can put a lot of that weight on your agent. If that's not for you, but you like what might be offered, have a good agent that you can lean on in that regard. And if not, go to Whole Life. I mean, Whole Life is really simple. There are a lot of very similar things that can happen to Whole Life, to IUL, but at the end of the day, you got better guarantees in Whole Life. And like, you never have to worry about the Whole Life. Like, I own Whole Life. I have very big Whole Life policies. And what I like about it, I don't ever have to worry about it. I don't even think about it.
That's a true set and forget it right there.
Yeah, I don't even think about it.
Pay my premium and that's it. Just let it grow. And great, good points. I would say that, how do you know you have a good agent unless you know how these things work, right? How do you know what questions to ask to see if the agent knows what they're talking? Right, that's what I'm saying. You gotta research. You might not have to know how to change the engine necessarily, but you should know how the engine works. That way you can ask the proper questions like, hey, is this working? Is this working? What's the maintenance on this? Like, you have to be educated going into these things because every agent says they're amazing. That's right. Every agent in the industry knows what they're doing, right?
If you go to my channel, if you go and you watch my videos, you can see that I'm an expert at this and I know the details, right? Because we talk about it, we don't hide it. My videos, when you go and watch, and it's not just me, but when you go watch my videos, they're not marketing videos. They're not hype fest. If you're talking to somebody and all you see is marketing, that might be because they don't know so much about the details. So always get second opinions. Always talk to multiple agents. There's nothing wrong with talking to multiple agents. A lot of people, though, they just make a purchase too quick. They kind of get hyped up from the marketing. They make a purchase too quick, and then they'll end up regretting it.
That's why you guys got to be really careful.
But that's the.
And it's in every industry, not just this one, but it comes down to education. So, James, really appreciate your time, man. I definitely want to get you back on, talk about a little bit about infinite banking. I love infinite banking. It's one of my favorite strategies. Definitely talk about that and a couple of other things, but I think this was a good start. We definitely covered some good points. So, really appreciate your time. I'll link your website down below. Where's the best place for people to find you? Your YouTube channel?
Oh, YouTube. Yeah.
YouTube. Yep. Oregon Cashflow Pro. Just look them up.
Yep.
Awesome.
All right. Hey, I appreciate the conversation, and let's talk again soon.
Sounds good. We'll talk soon. Take care.